Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show and Merry Christmas.
Happy holidays to everyone, Jim.
One of the headlines that caught my eye on your blog was Cryptomania, home of the Ponzi Kings.
Well,
what's the story there?
Yeah, well, it's just, watching the whole evolution of cryptocurrencies, Bitcoin being the leader of that, of course, over the past decade as it came onto the scene in 2008. It's really picked up incredible momentum in terms of believers, in terms of people thinking they can quit their day jobs and become just crypto traders, in terms of the infrastructure and services that have all grown up around this particular type of asset, for lack of a better word. But I think it's really indicative of our time, which has been where rates of interest have come down so low that the whole idea is that, there's no need to try and find legitimate things that pay an income and a reasonable yield, because none of that exists now. And so people have gone to just like full-on gambling with whatever it is they can get their hands on. And of course, there's a lot of people that have led this charge. The risk sellers, as I like to call it, are all making money on the front end by, getting people in. So this is very reminiscent of Ponzi, right, where you need new inflows coming in constantly to allow the original people to cash out or to have the asset value go up in price. And what people don't appreciate, and I've mentioned this before, but traditionally an investment was something that one assessed based on the cash flow that was coming to you, the discounting of the future cash flows. So that meant in terms of interest income on things like mortgages, rents on things like properties and houses, commercial property or residential, and dividends when it was in terms of stocks or preferred shares, this kind of thing. But what happened was that yields have got so low because prices have gone up so much. So this is the inverse of that real yields are now negative in just about every asset class there is. And people are holding a bunch of things like real estate where maybe they're collecting some rents, but typically the rents are insufficient to cover the overhead. So they have negative carry on these assets. So the only reason that anyone's holding these things is because they believe that they will continue to go up in price. Because otherwise, no one in their right mind would take money out of their working income to subsidize the costs of maintaining things, assets that don't pay for themselves, right? That is not an investment. That's a liability. But what we've seen is that everyone has really lost their way in terms of what they're looking for. Again, if you were to look at a GIC at the bank and they were offering you, 3 or 4%, that's pretty straightforward. You go, okay, they're offering me this rate of interest for the next year or two or whatever the term is, and then I'm guaranteed that they will give me back my principal at the end. So that is a finite date, a guarantee of principal, and a contractually prescribed rate of yield that you're supposed to get. Now, what's happened is that people have gone hog wild for things that not only do they not pay you any income, but they also don't give you any guaranteed return of principal date. There's no requirement that the people who take your cash are ever required to give it back. So this would be in things like cryptocurrencies where there's no principal guarantee of any kind. There's no income as you hold it. There's actually high friction costs or transaction costs. And actually, this is very similar to many of the stocks that are trading today as well in the equity markets. So Growth stocks, infamously they're called, don't actually usually pay any dividends at all. And so again, no one's compounding and reinvesting dividends to make investment gains over time, which is typically where the bulk of all investment gains have ever come from, is this rolling back in of income and compounding growth over time. So that isn't happening when something isn't paying you any income. The only prospects is that you'll be able to sell it higher to someone else at some point down the road. So people have really lost all sense of the difference between gambling and investing. And the Financial Times just wrote a really excellent article, which I posted on the blog, and they were just noting that crypto are in this category of what we'll call zero coupon perpetual securities or instruments. So in layman's language, that means zero coupon, no income required to be paid, no contractually prescribed dividend or interest payment, and no finite date, no maturity date, no return of principal date, hence perpetual. And the thing is about these things is that they have this infinite duration in that, you have to basically have an indefinite window of holding in the hopes it all works out. You have that against a population of people who are undersaved, who have too little cash, who have high expenses, particularly in the components of shelter these days, because the prices have gone up so much, and they have a finite time frame. So as I've always said, we humans are finite. We don't have these, pensions can maybe theorize over 40 and 50-year time horizons. That's not the average bear. The average bear has to be worried about the next 2, 3, 4, 5, 10 years. Those things all matter. And the problem is that when assets, even legitimate things, perhaps like a stock of a good company that is actually paying a dividend, okay, if the price of that asset doesn't go up, indeed goes down over your holding period, it will be a very negative experience. It will not be a good investment for you. And what people fail to miss is that when you get into environments where assets have become so obscenely valued as they are today, price to sales ratios of over 3% for just the S&P alone, and the peak of the tech wreck was just over 2 times sales. We're at more than 3.5 times sales. Again, negative S&P earnings yield. Stock earnings have never been this negative on a real basis. Cash holdings, personal savings rates, these things are all at record lows. And so people are highly levered here. They have a lot of expenses, and what I'm really finding is that people have highly correlated pots of things. So, for example, they may have a business income coming, say they're in the real estate space, or maybe they're an architect or an engineer, or in the building space, in a mortgage broking, in the banking industry. These things is where their income stream comes from, if they're indeed still working, for example. But at the same time, whatever savings they have taken and put into things like MICs, REITs, bank shares, and they have, so in other words, their savings is now entirely correlated with not just the business cycle, where those things go up during expansions and then go down sharply during recessions, but they also have the bulk of their wealth in their home. And that too is correlated with this very same cycle. So as I always try and point out to people, this is not diversification. This is highly risky, because if something goes wrong with the property sector, or if you get any downturn in prices, which again, historically we're at this extraordinarily high multiple standard deviations above the norm, those kind of things will resolve themselves eventually in the form of lower prices. And when that happens, we are very likely to see not only a recession in the economy, but a big bear market in these assets that have no guarantees of your principal whatsoever. So you really want to make sure that your business income or your employment, your job, may get interrupted, or you may get laid off. Your business may go through a difficult time of collecting receivables, for example. You certainly don't want that to hit you on the income side at the same time that your savings are plummeting. So this is the time to build up liquid savings, cash, things with guarantee of principal, so that you can keep them out of harm's way, so that if the economy takes a tank, if your business or income suffers, you do have these cash buffers, not only to support and sustain your household or your business through a difficult or challenging period, but also if you're very fortunate to have enough extra that you have optionality to purchase things from everybody else who's going to be selling in a panic. And that's really the conditions that we've set up for here.
Right. So many people have said it's easy to make money in good times, but the important thing is to hold on to what you have in bad times.
Well, and this is the thing. I mean, the stock market goes down 40% of the time historically. We've just been in this very anomalous period where, as I've said, there's been this really extreme response on the fiscal side for supporting the economy and workers' direct cash injections because of the pandemic, which we're now going into our third winter of, right? So this is going on and on. But we've also had this unprecedented infusion of cash into the financial intermediaries, which has made its way in, not into jobs or the economy, but just into financial speculation within the banking system itself. And so in that environment, people have really lost their way. And we've had a lot of, I'll call false prophets with a PH, come forth and, look like they're geniuses, look like they know what they're doing. And this is why I call this, the land of naked emperors, because you've got all these people, just really with no substance or track record themselves of anything other than the last few years when we were in this really anomalous period. They've never managed their way through bear markets. They've never protected from downside, capital under their management. They're still heavily indebted themselves. They're in a gambling mentality themselves. They're highly risk exposed, and they're the ones that look like they're geniuses in this environment. So you get into, as I say, any of these conditions which are typical, recurring, not anomalous. This is not about meteorites coming from outer space. This is all baked into things like human behavior and price. And when you get to these very, very high levels of price and very low levels of cash, the cash allocation, the Bank of America private cash holdings metric is now below 11%. It was at 11% at the very trough of cash and peak of asset mania in the 2008 cycle. We're now actually lower than that in terms of liquidity. The holdings of people that have things like guaranteed government bonds have been at an all-time low right now. There's only about 17% of all the portfolios even allocated to that, when those are the only things that actually do have any protective value in this type of environment when everything else starts to sell off. So you've got, if you look at the overall economy right now, it's quite remarkable. I mean, there's a lot of noise on a daily basis, but global GDP is, per capita is lower today than it was in 2019. I think that's the first thing that most people miss. So even though there's been all this panic to buy goods on cash infusions that's created inflation and bottlenecks, the fact is we have less GDP per capita in the world today than we did in 2019, even with trillions of all this types of support that have come in. Global GDP is tracking 3% now as a rate of growth in the fourth quarter, and it was 4% in 2019. So we have had a surge of some, as we said, buying of goods, but we're really seeing that slow down now. So at the same time, you're getting a ramp up in industrial production. Some of the bottlenecks are resolving. You're getting a lot more goods and inventories. We have, at the same time, this new wave of pandemic. So the indoor dining reservations, the passenger traffic on airlines, even retail sales is all very much lower than it was in 2000 at the same week of 2019. People are just very underinvested in the things that are going to protect them or give them liquidity, and massively overexposed, as I say, in this one risk trade where everything is correlated together. And I think that that's going to end up being very, very bad, because people don't have the ability to absorb and ride that out. And as I've made the point several times, which is often missed, they think, because we've had a few, severe drawdowns quickly, for example, at the March 20 experience where everything sold off really fast, but then also bounced back within a matter of that same year, people are conditioned, they think that is what a bear market is like. In fact, the bear market is typically something that falls and loses over a couple of year period. And indeed, in the instance of major secular bear markets that began from similarly high valuation peaks, if you look at the Nikkei in 1989, you see that to this day, all these years later, more than 32 years later, it is still nowhere near where it was at the peak. And so when you look at something like the TSX today, the S&P 500, really in particular the S&P 500, it has been this gong show attracting in all this, like more cash has gone into stocks in the last year than in the prior 19 years before that. Like, it's just off the charts bonkers what we've seen. And so, as I say, these are all extremely long duration with no income assets. So the only reason you'd be holding them here is betting that they're going to go up further in price. And while that may be true in the very short run, in the longer run, that is almost never going to be the case. And the problem is that, again, if you look at what's happening this cycle even, we have a lot of indicators to suggest that we may indeed have seen the peak of inflation, the peak of growth, the peak of many of these asset markets. Just the long duration bond, for example, the 30-year U.S. long duration bond peaked in March at 2.5%. It's now 1.86. What that means is that the bond market is looking forward and seeing this slowing growth period, this less inflationary period, and that is a problem for these assets which have priced in this exponential and ongoing growth in earnings, for example, which is not coming to fruition. The other thing we notice is that commodities, which are again supposed to be a leading indicator of demand and spending in the economy, actually peaked in October, and the Goldman Sachs Commodity Index is actually back to where it was in 2018 today. We see things like the Russell 2000, which is small cap stocks, the Dow, the TSX, all of these things peaked in November and have not made a new high year to date after that. So everything's kind of been rolling over under the surface. The same with the Canadian dollar. You know, it's a petrocurrency. It trades with commodities. It trades with inflation expectations. What you've noticed is it peaked in June of 21 and at 122 US dollar, and today it's around the 129 mark. So all of these things are really, the China large cap ETF, this is another one I don't think people are paying attention. China large cap ETF just took out its 2020 low, Jim. It's March 2020 low. And the really broad NYSE, New York Stock Exchange stocks, over 41% of them are now, just 41% of them are above their 200-day moving average. So under the surface, a lot of things are already rolling over as people continue to hold these really highly speculative, non-investment grade instruments with whatever savings they have. And I think that's really setting up for a lot of trauma.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, so many people feel the Fed has your back. They're not going to allow another major crash like we saw in 2008 or 2000 with the dot-com bubble burst. They're going to protect us. What's the real story?
Well, I wish I could think that. I've been at this, 30 years now, and I have to say that I've heard that before. Certainly in the late 90s, there was this adoration for Alan Greenspan, and they called him the maestro, and the belief was that he was a genius and he knew how to manipulate monetary conditions to such a degree that he would never let markets go down. Well, of course, since then we've had two massive wipeouts, both in after the 2000 peak and after the 2008, which manifested into, let's not forget, the global financial crisis, which we still refer to it as, and yet we are more indebted, levered, and risk exposed today than we were at the peak of the 2007-8 cycle by a factor of, by a lot. So they couldn't prevent it from happening in the last two cycles. They didn't prevent it from cavitating, down 37% in 15 trading days in March of 20. There's just no evidence that they can either prevent a recession, which has happened something like, dozens of 18 times or something since the 1800s. They don't prevent recessions. They are meant to be the lender of last resort. So Walter Baggett was the person who recommended the policies. Many of them some of them were introduced in the Federal Reserve Act when it was set up, the U.S. Central Bank. But basically the idea being that they're supposed to only provide liquidity at a high rate of interest to those who can't get it elsewhere in a time of crisis. And the idea was it would backstop any kind of actual collapse of the system. But of course, over the past few years, they've become as I say, the naked emperors that everybody looks at and thinks are magical, when they don't have the powers that are perceived. So they have powers of persuasion. They can, talk big and carry a little stick. They can try and use moral suasion or encourage people to take risk through their comments. But in terms of if risk aversion actually takes hold and liquidation cycles, as I say, at some point here, people will have to sell whatever they can. It's not about, I love crypto or I love gold or I love stocks or I'm never going to sell whatever. They will sell whatever they can, the good, bad, and the ugly, to get liquidity to pay their bills, to pay their taxes, to buy their food, to keep the roof over their head if possible. They will have to liquidate things like even real estate, which of course takes longer and is more difficult to sell than things like securities typically. So all of that, once that quest for cash really kicks in, the central banks of the world are impotent against that. There's nothing they can do. It just has a weight of its own. It continues. And in the past, they had the ability to at least slash interest rates to try and revive animal spirits, or to step in and, do this QE, which is really shock and awe because it was a fairly new concept. It was borrowed from the Japanese experience in the early 1990s and on. And they hadn't implemented it to a large degree in North America or Europe. So that was all a kind of a trick they picked up in the last decade. But, now they've been doing that ad nauseum, even through the recovery stage, even through the so-called expansion in the economy, they continue to do all that. So they're really, completely lost their shock and awe factor when it comes to that. And so I just think that, we're out of tricks, and the next phase is going to be who's got cash, who has debt, who doesn't have debt, who has liquidity and security to withstand a downturn in the economy. And those will be the people who end up owning the assets at prices that are really investment grade again, from all these weak hands who have been buying them with price indiscriminate, just grabbing whatever they can and borrowing money to do it and all that. That's classic behavior of a top.
Right now, all the banks, other companies that have had record profits over the pandemic are buying back their own shares. Should they not be keeping that cash on hand for a rainy day? Because if there's a downturn in the economy, they're going to go begging to the government for bailouts.
Yeah, so that's again something that is just indicative of this period we've been in, when everyone thinks that cash is not useful, is worthless. And so what they do is they raise money at next to nothing in the marketplace. They can't find a way to actually organically grow their business in this environment of, aging population and, working age population declining in all the major economies. So they can't find a probable growth story in their actual base model. So they do things like manufacture earnings growth by buying back shares. And that all looks good, as I say, in the expansionary phase, as long as the shares are going up. But once they start buying things, the shares are falling, and they're literally like burning money in the backyard to, they're giving away liquidity and cash in exchange for these securities that are plummeting. Then they quickly realize that they can't continue to do that for very long. And that's why at cycle bottoms, companies typically aren't buying their shares at all when they would be the best value or investment grade, because they didn't plan for it properly. So again, you have to think ahead of the pack and actually take preemptive steps before everyone else in order to be positioned to benefit from this cycle.
Do you think sometimes people are embarrassed into not holding cash, with people saying, what are you doing just holding cash? It's not making any money for you. You're losing money right now because of inflation.
Absolutely correct. Absolutely. And not only that, banks, of course, are trained that if anybody's got a few $1,000 in an account, that they're on them like, bugs. They are supposed to call them up and tell them to meet with their financial advisors, or, that they're missing out. And, I've just seen unbelievable, self-destructive activities in the last little while, and even people that are, quite educated and should know better are doing things like, asking where they can invest money they've set aside to help their kid buy a house or something, but they're not doing it till the spring, so they want to know where should we invest it in the meantime. It's turned the world into this perception of cash as this hot potatoes that you have to throw at anything, just get them off you at all times. And that's all part and parcel of the salesmanship of the financial sector, and indeed of central banks themselves, right? Because as I've mentioned before, they're in the business of manufacturing the expectation of rising prices. They don't want runaway prices, but they want everyone to think that things are going to be more expensive next year than they are now, because that's their base case for getting everyone to spend their cash now. But if in fact prices are not going higher, if in fact they're just stagnant or declining, then the case for holding cash becomes really overwhelming, because you're actually making purchasing power gains just in not deploying it too early and waiting for that value to come back in the system. So yes, buybacks have just been an example of this same disease that's gripped everyone.
Danielle, thank you so much for chatting with us, and all the best of the season.
Hey, you too. Let's hope 2022 is a little more productive in various ways.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Check out our websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com and we'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.